going to let a little bit of time for everyone to be able to connect their audio, be able to listen to us. I'm actually going to use the time right away before introducing my two lovely guests for today. I'm a very lucky gentleman right now, to also, right away give you the little reading of our, regular disclaimers. So here it goes. I'm not still going to have my French accent speaking that way, but let's see. The opinion expressed by today's panelists are their personal views and may not reflect the views of the organization that they represent. Whenever possible, AMI has verified the accuracy of the information provided by third parties, but does not under any circumstances accept responsibility for any inaccuracies should they remain unverified. It is expected that webinar attendees will use the information provided in this webinar in conjunction with other information and with sound management practices. AMI therefore will not assume responsibility for commercial loss due to business decisions made based on the use or not use of the information provided in today's webinar. Now that actually I made our lawyers happy, and that's it for the rest of the week, let's actually focus on something probably more interesting, which is to actually discuss right now what is the topic for today, which is the attempt at increasing sustainability into the mining sector, moving the sector from brown to green, as we labeled this coffee chat, and be able to discuss it with different cases where we're going to be talking about water issues specifically. We're going to be looking at specific approach that both investors and mining company can actually undergo to green their operations and be much more into the evolution of what investors now are demanding before investing into their projects. And to be able to discuss those topics, I'm very lucky. I got Anna Poberezhna, who actually is joining us from Smart for Tech, and she's actually based in London, and she'll give us her expertise from, let's say, an expert of, let's say, water metrics, of calculating the use of natural resources by different operations, and how this actually has really stepped up into the importance on the agenda for many investors and mining company. And we also have Nicole Anderson, who is coming from more the investing world. So probably definitely will share with us, because I'm going to ask, what are the different variables that she's looking at in terms of investing into a property, and really looking at really this concept of ESG finance, trying to unleash value into some input of production or some process that have been taken for granted for a long time. And a lot of companies don't see how they can become more attractive to investors, or also make much more value and more return on investment if they integrate more those issues of natural resources into their own corporate approach and strategies or operations. So let me just first and foremost probably turn to our two lovely guests and ask Anna, maybe just first to just introduce yourself and Smart for Tech. You probably will do it better than I could do it myself, so that's much better than I just listen to you. Please, Anna.
Thank you, Remi, and thanks everyone for having us here. I would correct a little bit my introduction. Yes, I've spent in the water space probably past 4 years, but I've spent in digital and fintech space as well, past 5 years, where I was trying to connect unconnectable dots until recently. So it's digitizing the water and translating whatever that means into the financial world. And I think the biggest problem is around the disconnect and the different definitions between what is a contextual definition of water in a particular sector, its use, its intensity, its risks and impacts into the financial metrics. And that's what I spent doing, and helping to manage uncertainty around the different assets and creating new asset classes for investors, basically new types of financial products, and which can have a competitive advantage from the perspective of sustainable development and from the perspective of their resilience, business resilience and sustainability. So that's what I've been doing. And last year, I was introduced into the mining sector, which is part of the natural resource management, where water has huge importance, both from the cost perspective, from the risk perspective, and from the impact perspective. Could be negative and positive. So I understood that water and mining go hand in hand, and risk, regardless of their high risks, opportunities are even higher. And I think we should talk about creating opportunities during this seminar and
I fully plan to do so. Don't worry. We'll focus on opportunities specifically. Maybe I'll turn first to Nicole just for our own introduction. If you can actually explain a little bit how you came into ESG finance and your views on the topic, obviously.
Of course. Thank you, Remi. And it's great to be with everyone here today. I think it's morning for most people, but it's nearly evening here in rural England. So yes, I, like Anna, have had a slightly tangential career in technology and technology innovation, but very broad. I've always erred on the side of technology innovation, working in a number of different roles, looking at, particularly how physical supply chains can be reinvented and be made more efficient. In the last 10 years, I threw myself into the world of FinTech and FinTech innovation. And that has given me quite a broad exposure to essentially capital allocation challenges, all right, specifically in markets such as commodities and mining, of course, but across a broad industry spectrum. I spend my days doing two things: aiding the allocation of capital in private markets to worthy projects that are defined, however, all right, and this is a moving target really, as green or impactful. And I actually am involved in the creation of innovative new ventures that have a financial technology baseline, right? So I'm both an entrepreneur and an investor thrown into one. So I come at the world of the challenge quite differently. And the world of green or sustainable finance, we can get into the definitions, but of course, there are a number of the phraseology is complex and frustrating because it's interchangeable. But I think, for the baseline, the people like Anna and I represent voices, independent voices very often, because we've been through a cycle of innovation many times over. And what sustainable finance is for mainstream finance is, certainly in my opinion, I won't put words in Anna's mouth, but a huge innovation opportunity because of the concentration of time we have to activate and adhere to policy regulation implementation and just the accords, specifically the Paris Agreement, we all know. So really, the industry at large, the financial industry, global financial industry, everyone admits that something has to interject, some radical transformation has to come into the fold, and that cannot be done within the system. That is going to require external insight and really unpicking some, precursors, models, the way in which finance has been structured historically in order to affect the change at pace. So that's what I spend my time doing.
No, wonderful. And maybe I'll follow up after with you on the specific question on what are the criteria that make a valuable investment. But maybe first to Anna, and can I ask you maybe for a general, let's say, introduction to, how can FinTech and ESG finance metrics be useful for the extractive sector and the mining sector in general? In a very general introduction, I was just looking very quickly at people that are attending. You have people from mining companies. You also have people from indigenous communities, investors, lawyers. So there's a very diverse set of people attending, as always. Can you maybe give us, in 4 sentences, a little bit of introduction of how FinTech is related to mining? And obviously go further, much more than 4 sentences, because you're going to make it very interesting. So please don't listen to my limits.
Okay, I'll try to simplify it as possible, and I'll try not to use a scary word as a FinTech. I would like to look at the problem and what we have at the moment right now. So there is a big disconnect between asset to asset and between portfolio to portfolio. What do I mean by that? Asset level, mine site, and then asset level of investors. And their terms and terms that are used and definitions are very different. So there is a disconnect. It's like we literally need a Google Translate between two, which is normal because it's a very complicated industry on one side, mining and water, and then there is a finance. Mm-hmm. And that's why there were some sort of type of frameworks developed, standards and frameworks, accounting and reporting, that are trying to help to bridge those two worlds. be it ESG, and there is no taxonomy, so there is even more burden than mining companies to report that. Then there is various reporting frameworks, TCFD, GRI, which is merging right now with SASP. And then there is also industry frameworks, reporting standards like ICMM. So, and then there is also, we have CDP and many others. So to me, it sounds sometimes that it's not easing the task of communicating systematically the risks and the associated costs and the impacts of what is actually happening on the ground in that contextual way to their external stakeholders, which don't include only investors. It's also communities, it's also NGOs and many others, but it's actually complicating even more. So, and everyone then asks, okay, finance and water, so where's the data? And so FinTech is coming here to simplify that task. And not just, we're not talking here about FinTech, we're talking here about digitalization or digitization, where we need to harmonize the data to create a fuller picture view. So both mining companies or mining sector, metals and mining, and investor sector, and many other stakeholders, which are important participants in that, because mining is a global sector that operates locally. So we need to convert local into the global and integrate it. And that is the task of FinTech, or as you could say, or digitization, to harmonize the data, to translate it, and systematically deliver that in their perceivable kind of manner, understandable manner to the different stakeholders. And most importantly, data sets that are missing currently or are out of the context, they have to be credible as well. There has to be, what's happening right now, there's lack of confidence and there's lack of trust of the information that has been presented. And technology here is just an instrument, an enabler to bring that required level of transparency. We're not talking about total level of transparency, but required level of transparency, and systematically communicating and streamlining that necessary data for decision makers, both within the company on the board level and for investors, which will simplify the communication as a result between them.
Yeah, wonderful. I probably will have a follow-up talks with you on transparency and best practices in terms of being able to develop sound data set. But maybe turning to Nicole first onto the idea of how you use, let's say, the metric that maybe Anna, or the data that Anna will provide you, or anyone else. How do you actually allow to manage to quantify it and be able to see, what would be the investment that in the long run would actually not be too stressful on resources and therefore will ensure a better return on investment to investor? Can you actually walk us through those different, content and categories or variables that you're looking for to be able to highlight a valuable investment with the new elements of FinTech and ESG finance that now are very useful to just change, obviously, the views that we have on certain projects, as opposed to what was done as business as usual?
Sure. So Remi, I think the first thing to say is, if I was sitting in public market activity, then it would be quite a different story. But I'm today, I mean, the honest truth is I'm a private market investor. But maybe I could touch on the public market structures and challenges, because I think, many participants would, benefit more from that in terms of the institutional community looking at ESG. Well, I think for most participants who are familiar with sustainability will understand that ESG is a moving target, and it is for the most part, I think, being misappropriated and misused as a mechanism, because there hasn't been a single mechanism to define what ESG stands for, irrespective of the corner of the institutional community you play in. And so the release of the EU taxonomy in sustainable finance is a first attempt at trying to draw down consistency in the interpretation of what specifically for listed or public markets, a sustainable investment structure could look like. And I think that taxonomy, which is in the public domain, is super helpful. And it is deep and it is wide. What I think that will do, certainly for the institutional investment community, is create greater clarity. It will represent, I think, a big consolidation on the definition of ESG. And I would imagine all those ESG data providers, which I think now last count exceed over 170 players, there'll be massive consolidation, right? I mean, you know, there's been some, let's say, I guess there's been an opportunity there, a market opportunity for players to come in and score. But the biggest challenge for investors, both public and private, has been, all right, what essentially is what is the unification? And I think the thing now is that once we've got the taxonomy in place, that rigor, that discipline, essentially those defined mechanisms and structures will flow into private market activity. And private market capital allocation is predominantly, you know, right now, very concentrated, certainly on a project financing basis, with debt instruments and debt products. And that again has an overlay of, all right, okay, so if we're looking at the plethora of mechanisms to understand in the fixed income space, what is essentially, you know, a graded bond, that is a huge challenge. So to answer your question, I think there is, many investors have had to adapt and evolve, whether they be public or private, to moving targets. And I personally, because of the nature of the investments I'm looking at, which all have a bias to technology and always have a bias to how the fintech element of that technology could enable or catalyze decarbonization. I look at scale, I look at being able at traceability and trackability, okay, of capital allocation, the onward monitoring of that capital allocation and its impact. And I look at tenure, right? So this is for me certainly not a transactional exercise. And the kinds of, when you break that down further, I mean, clearly impact for me is all about the onward supply chain, the exposure of counterparties, and the technical insight I would need to have in certain ancillary, you know, industries, whether that be, you know, a commodity-based industry such as mining or logistics and transportation. But I've, for example, spent a lot of time in the real estate industry and sustainable real estate industry. So again, the tracing and tracking of raw materials, all right, from source to, you know, full development is another aspect that I would consider as very key in my armor when looking at the allocation of the initial allocation of capital and then the onward monitoring of that capital.
No, absolutely. I think that's very, very interesting. And you mentioned specifically, you know, tracing and tracking, the importance of looking at all the discourse and the evolution that we're seeing on supply chains out, you know, in the mining sector, not only for, you know, supply chains of mining companies, but also obviously for the commercializations of minerals. I mean, if people go back to our LinkedIn page, a specific interview with Terry Heyman for the World Gold Council that discussed the responsible gold mining principle. There's a lot of work that is available with the United Nations, Sustainable Development Goals, and how this actually being mainstream into the mining industry. So there are a few cases. I see Andreas actually just sent the LinkedIn group address if you guys want to actually look at this. But I'd like to turn to Anna and just, you know, continue on this link with, you know, trackability, tracing, transparency. I remember when we were starting discussing about how to prepare this talk, you said, like, first thing, transparency is the new black. And that actually stuck into me, saying, like, you have to be able to be tracing and divulging this sound data to gain, again, the stakeholders' confidence and trust. Because at this point, we're seeing a series of social license to operate issues throughout the projects that can actually be much helped by some of the, you know, metrics that you provide, Anna. So maybe can you actually just go a little deeper onto how this transparency in terms of providing data on the use of natural resources and, you know, such as water and others, can actually be an essential tools into regaining confidence with stakeholders and shareholders also on some aspects. Please, Anna.
Thank you, Remi. It was a great question, and it's probably one of the most complicated questions.
I think that was your question. I'm just repeating it, so you have the credit for that question.
Before I jump into that, I would add to Nicole's, because in the past 6 months, I've been communicating a lot with private equities, with banks. I would like to reinforce the point, and this is also to support Nicole's point. There are different types of investors or financiers. We really have to understand that finance community is very diverse. And we have asset owners, we had asset managers who have fiduciary right against asset owners to allocate the capital or their investments appropriately. And they looking not just from the risk perspective, traditional risk perspective, which includes physical, reputational, regulatory risk assessment, the classic ones, right? But we also now have, according to TCFD, and because of the climate change and many other growing aspects, transition risk. Mm-hmm. That includes other aspects, which before were not quantifiable. And as we know, risks, the outcome of the risk is costs. And that's why it is very important for investors, different types of investors, understand a whole picture, because in the end of the year, it's not just mining companies that need to provide disclosure or reporting, not just to investors, but to larger group of stakeholders, but it's also investors as well. And I think it was recently that actually BlackRock, probably will be able even to quote, said that water stress is a key component of climate risks that are set to grow increasingly financial material over time, which suggests that the time to integrate them to investment processes now. So the takeaway for investors from there is companies that manage water resources better than their peers may offer resilient earning streams. So that's for investors. So as a result, as a waterfall, it will be a question to the companies and industries that operate in the high water stress areas, how they're managing those risks. Yeah. The total or the cumulative risk assessment or impact assessment is becoming mandatory. And as we know, water, and that's where we're coming back right now to a specific question, water is a dynamic risk. It's not a static risk. And the issue right now with investor, and this is where happening a gap between the understanding of what's going on the ground, is that a lot of reporting is done in a static way or based on the static indicators, which don't represent necessarily the whole picture or the actual picture of what's happening on the ground. And so there is basically a disconnect what's going on the asset level. That connectivity is required, or connectivity or streamlining is required through all the way up from asset to boardroom to investors. But it's not about just streamlining the information and to expose high risk industries to a high exposure of the risk, because mining it's a de facto is a high ESG risk sector. And but their importance here is actually to streamline the response and the mitigation actions against climate change, against ESG risks, and how company actually managing those risks. Because there is a big gap of understanding of communication and understanding by investor and financial community. What are the actions are taken? What is the total cost of water, for instance? What are the impacts, financial and non-financial related? And we also know that it's very important to understand it in the short term, basically, which will affect the revenues potentially, and then what is the long term, which will affect the business resilience. And again, then it's coming back to who we can communicate into. Are we communicating to insurance? Then we need to speak about catastrophe risks in the next 18 to 24 months, which is parametric insurance, for instance, or we're talking about overall insurance. So it's and how the extreme events in the forward-thinking models, not in the backward-thinking models, actually calculated and managed those risks and managed and responded to. That will increase the confidence of investors, and hence indirectly, of course. So there is a lot of gaps. It's a very complicated issue. So we need to understand what information is required by whom, and then fill in those gaps of those information. Sometimes investors or investment community require just data sets, not digested information. So it's a matter of agreeing that unit of exchange that is needed for a right stakeholder, because obviously local communities really need different information from policymakers, from investors, and from insurance companies.
Yes, and when you mentioned actually the different actions or strategies that mining companies can undertake for, you know, improving the sustainability of their operations or the quality of the reporting, I guess the entire thing here is the difference between greenwashing and sustainable transformation. I'm looking at, you know, what are the risks, but also opportunities that you can get into the long run with sustainable transformation. I'd love to get your thought on this, but please, before with Nicole, maybe just to comment on what you just said in terms of the position and the move that we're seeing from the investment community. I mean, Anna rightfully mentioned BlackRock. We've had talks with different, you know, Société Générale, for example, has now, I think it's a 5% discount in terms of the loans based on the social performances of the companies that they support. Now, obviously, the reporting on the social performances and others still needs to be improved, but we do see a systemic change among the different, you know, investment communities, especially in London or in Europe or in some other, you know, Canada also very specifically looking into this in some of the actors that we talk to. What is from you actually inside this investment community, if I may say, what's your take from this? And maybe can you actually tell us where this would go after more than just the BlackRock and Société Générale kind of small progress? What are we looking for in the long run into the inclusion of ESG finance into decisions?
Well, I personally think, lucky for me, you know, I'm in a place where I'm kind of feel like I'm witnessing history being made, right? So absolutely, you know, the institutional community right now is in a process of upskilling at a scale we've never seen before, right? And that is time bound, number one. Secondly, it's being forced upon by oncoming structures, policymaking, regulation, and that'll be a global situation before we know it. You know, for example, again, EU is leading the charge from what I can tell, but I think it was last year, October, any EU, any G20 finance minister within the EU had to commit that their asset management industry would be able to report annually on emission targets across an investment landscape, right? Every single portfolio had to be accountable. Now, I mean, that's a lofty goal at a very high level, but immensely complex, right? When you kind of decouple that, because the challenge for the more complex, more institutional investors is, of course, the portfolio construction of old is not going to look like the portfolio construction of today or tomorrow. So along with the need, okay, of the institutional industry, investment community to upskill, they are having to deal with essentially the backlog potentially of capital allocation. They're having to place capital, and the challenge is, where do they place this capital? And given the fact that the mechanism of ESG is moving around, they are finding the quickest route to the market. So what I'm seeing is I'm seeing institutional flows into fairly mature impact investors, right, who are able to deploy at a project level. So lucky for this community of impact investors, you know, they're spoiled for choice, right? So their onward LPs are abundant, and that's an interesting move. Because the private market now is essentially seen to be the distribution mechanism that can make, it always has been, but essentially the private market role in being able to scale mid-size projects globally is critical, because they're closer to these projects. They have the technical discipline. There is an interesting move in what is defined as private market capital. So what I'm seeing is this new class emerge with alternative investment managers who have more flexibility than institutional, potentially institutional money and capital, but are more willing to structure in flexible ways and, dare I say, more sustainable structures for the future coming into the private market, which is super interesting. So I'm seeing alternative investment managers placing bets on new structures, designing and structuring their own walls of capital in the impact space, and partnering with more mature impact investors. So I think what we'll see is I think we'll see a lot of movers in the distribution of capital from institutional to private market, and it's all up for grabs. So it's a super exciting time. And I think this plays to almost any industry's advantage. If the projects are able to work, I mean, this is not, I think most investors realize that at project level, this is a journey, right? Data and real world data is something that doesn't happen overnight, but every increase in insight creates value in that asset. Every insight and value creates an onward market for that investor. And if they can stick and provide that knowledge capital back into their portfolio, then all the better for them. And that's the arbitrage that most investors are looking for.
Yeah, and since we're talking, I mean, you mentioned technical discipline, you mentioned your data being reported in others, and I'm looking at the question from Remi Piet on the chat. I mean, when he's looking at the major banks evaluating green and sustainability investment, he's asking which standards are banks using today, or basically are they making them up? I'm quoting the question. What would be your take on this? And obviously then Anna, of course, because I think she's probably a good expert to answer that question, please.
There has been no standard. Is the simple answer. I think, you know, for the longest time, essentially portfolio construction and capital allocation has been non-regulated. You know, there hasn't been a taxonomy in place. That's now changing rapidly. So essentially these institutions have done their best, so to speak, and predominantly piled into listed structures, right? So whether that be, you know, passive indexes, you know, the ESG, the challenge with ESG, and we know this, is that it's very much a one-way reporting mechanism, right, historically. So it's been an academic exercise, and it's been up to companies to report their score, essentially, however frequently, and the investment community to accept or apply an overlay of an analysis, depending on the relationship with that multinational, for example. So I think they've all applied different strategies, but that is going to change. And I think it's, you know, it definitely has to.
Yeah, Anna, maybe if you want to chip in on this and look at, you know, the question of standards and potentially the difference between, as you were saying, you know, greenwashing and actually sustainable transformation of mining operations. How can, you know, we see or assess that a company actually adopts the right, you know, processes and base case practices into assessing their ESG performance, reports it correctly in the absence of a standard? What would be your take on this?
So there is no taxonomy on this. And again, we need to understand who we're talking to. Are we talking to their commercial lender? Or we talking to their asset manager that is creating there is a portfolio construction exercise, or we're talking to the private equity. Anyway, in all cases, so there are existing standards and reporting frameworks, which I mentioned initially, and certain certificates have to be provided as part of the ESG check. So there is no such a definition as green KYC, but I decided to squeeze it in and call it green KYC. It's basically, it's a due diligence on the company or corporate profile with the purpose of assessing, there is a classic assessment exercise which looks at the balance sheet, income statements, and credit rating risk, and so on and so forth. But there is now, we have this ESG and SDGs performance. And that has to be validated quite often by also third parties as well. And this is where certain certifications like IRMA, for instance, comes in, where equator principles coming, where ET initiative comes in as well, and many more. But again, reporting and accountability is not just defined by that. So that's much more relevant for the trade finance application, working capital, which is also often used in the trade finance. This is where those certificates are requested. That's where we're talking about supply chain. However, in this case, we're talking about the physical risks that are happening at their operational site level, which we're talking about the project. So we're moving, the whole kind of system is moving from the supply chain assessment or transparency and information associated with that into the value chain. And that's a whole complex major shift, then I would say market shift right now, where mining actually sits on top of that value chain. Because it's not just mining production or trading company of the minerals or metals, but it's actually a natural resource management company or organization, which also happen to operate in their high water stress areas, in very poor areas quite often, and in the most unusual regions in comparison to other sectors. So much more assessment is often needed for that. Mm-hmm. And there is no set single framework. If we're talking about the banks, lenders, each of them has their own policy, which is available on their website. If we're talking into multi-development banks like EBRD, again, they have their own policies. If we're talking about IFC, then a lot of banks rely, or a lot of assessment frameworks also correspond to IFC performance standards. Yeah. Also, IFC has developed ESG, different guidelines. So we need to understand what are the purpose of assessment, what are the end goal of that? Are we applying for working capital? Are we applying for credit line? Are we applying for sustainable finance? And sustainable finance can be structured differently, as Nicole mentioned before. It can be debt, it can be equity, it can be mixed, it can be green bonds, it can be ESG loans, and so on and so forth. And unfortunately, there is no standard. Hence, that means for mining companies, they need to be ready with a set of information that can be fed into very much individual type of policies and individual processes which are created by different institutions. So it's like packaged set of data or a set of information which can be literally pushed at demand, for instance, and not just at this point of time, but also should reflect, if we're talking specifically about sustainable finance or sustainability linked finance, to say correctly. Yeah. It's a period of during the period of course of time, over the, for instance, X amount of years, and it should include historic data, current data, and future forecasts, and to show those KPIs against the set targets that company has, 2030 for instance, and then other targets that are associated with the local region where those companies operate. Not to say it about even basin level, where this is a very different even discussion because it comes down into the risk assessment.
Yeah. I'd love to get Nicole's view also of how, and thank you, Anna. I'd love to get Nicole's view on how she navigates between, let's say, the IFC guidelines, the OECD guidelines. There's so many, obviously, all actors try to get maybe their own framing of the question of the. Before I do that, I just want maybe to answer a specific question from Donald asking whether this will remain a priority under a recession. Actually, I believe it's even more the case, under the cases today. We're looking at, gold prices now surging to $2,000. Copper prices are doing very well. And others, that means what? That means that a lot of different, there's going to be much more interest from potential extortion of mining companies, potential issues, trying to see, because they're making more money out of their ounces, if there could be potentially more obstruction to development of projects. But more importantly, it also means that mining companies will have an additional interest in trying to develop assets or projects that were right now stalled by severe ESG and social license to operate issues. And therefore, that's why it's so important to be able to, potentially be ahead of the curve, communicate transparently on ESG, on concerns, so that you actually are faster than the opposition when you're going to be announcing the potential relaunch of a project. And I think that's really essential. And that's part of, some of the work done by OECD that IFC mentions. That, Nicole, when you're from your position, when you see all this framing, obviously the framing of E is different from the one on S, on G. I can't repeat enough the fact that you have to get a specific due diligence or assessment of the qualities of your work on the environmental level, but also on social and governance, which is completely different framework and can be actually assessed a long time to just reassure investors and to gain the social license to operate. But how do you work, when with those guidelines, with IFC, with ESG, with other financial partners? Can you help us navigate through all this, please?
Yeah. No, I mean, it's so interesting because it's these three key pillars essentially again have different levels of maturity, adoption, and interpretation. All right, and that goes across investor category and industry. So I think there is an opportunity certainly for both project and financier to actually provide as much of, this is about the interlock of where the capital goes, right? So predominantly what I'm seeing is a closer tee-up and a tie-up. So the straighter the line to the capital to the project, the better chance, all right, of that project. Even if things are essentially all the boxes are not ticked in terms of what one would define as an expansive framework, is a better chance of reallocation of capital. Mm-hmm. So that is, a very generalistic look at how I'm seeing certainly the institutional market evolve. So you're right. There are a number of different bodies. Last count, there was probably 40 different bodies over time that have developed predominantly, to tackle what the sustainable finance taxonomy has now, I think, got a grasp on. But you've got the policy for responsible investment, the same for insurance. You've got Climate Action 100, which I think is probably, I take a lot of lead from that community because again, it's vastly very well represented. What I like about what they have done is they have worked very, very hard to be able to educate their members on the synergies and the commonalities, of policies, certainly coming into the E versus the S. The other thing that I think is also very interesting to note is that on balance, I think what I'm seeing is the acceptance of real world data as being a big trigger for insight in terms of portfolio construction for environmental considerations, obviously. The data around social and social impact is far more difficult, right? And that's where I think a lot of innovation can come into the fold, being able to trace and track and look at the onward effect of, as we said, supply chains, but also the communities that are in place, the physical communities that are around, and also the conditions associated with the operations of a business, right? So there is obviously a consideration for employees and the way in which diversity is one thing that comes into play. Governance, again, I think there is a lot of work to do around how again, the monitoring, mitigation, and adaptation is folded into board level reviews and reporting. We're also seeing an evolution of the accounting principle models, again, across multiple industries. So it's a hard one, Remi. I think we're right in the middle of the storm. It's fascinating, but I would maybe just summarize by saying the world of finance is changing, and the closer you can get to forming the relationship, the direct relationship between the capital source and the project, the better. And there are many ways to do that.
Wonderful. And maybe just moving on to these positive notes towards Anna, I mean, I'd like to focus more like on untapped opportunities. And obviously when we talk about ESG from the mining perspective, you know, it's like if it's not a slap on the wrist, they don't do well on the environment, a slap on the wrist. They actually impact negatively societies, a slap on the wrist. They impact badly, you know, governance, same thing, punishment. There's actually strong possibilities to actually generate business value by, you know, positive impact on this ESG layer. Can you maybe give us more of a positive take on this potentially, and show, you know, investors and miners why it makes a lot of sense, you know, also positively for them to dedicate time and sound protocol on those issues?
Well, that's a great question. I'm a very firm believer that, hence I made such quite a bold statement, that mining sector can be a leader of sustainable transformation. Mining sector, metals and mining sector is actually a real economy sector. And that has a huge, I would say, for them, cost and benefits on both sides, which are, and opportunities which are untapped. I think the World Economic Forum recently published their study that there are 15 transitions in 3 socioeconomic systems that could deliver around 10 trillion of annual business opportunities, annual, and 400 million jobs by 2030. Where mining companies or mining sector or extractive sector sits, it sits within 1/3 of that. So energy and extractives account for 3 trillion of annual. Well, the total jobs creation of 87 basically million by 2030. And this is something that had been published literally, I think, last week. To compare risks with opportunities, I'll step out a bit of mining sector, and I'll give some comparison statistics there. So I think CDP published value at risk in the mining sector as dated of 2018. It was 25 billion. Whereas we see immediately that green mining market size by 2024 will be 13 billion. So still there. And if we look at their other opportunities versus risks, so the sustainable investment market size is around 31 billion was. Climate business opportunity, and now we're going on the rising, 2 trillion. Circular economy opportunities, 4 trillion. Then water infrastructure or green-blue infrastructure, it's 6 trillion, almost 7 trillion opportunities. Climate adaptation net benefits, 7 trillion. And then I mentioned this business value by 2030, by 2020. It doesn't mean that this is all just for mining sectors, but there is a fraction which mining and metal sector can tap in by looking into their new revenue models and new business streams. There are two aspects. Basically, managing costs better, associated with risks, associated with ESG risks, impacts, and climate mitigation and adaptation, that's the first thing. And then on the other side, it's looking also at the opportunities, and mining sector is looking at the opportunities, how to manage their operations more sustainably by using innovative technology, for instance, and it's highly it's adapted. But it's not just looking within the mining concession, it's looking outside the mining concession, because mining companies in 10, probably 15 years will not be just mining companies. Not to say that they have vast amounts of data that they can manage and produce business intelligence. That's one point. We're talking about digital side, but on the physical side, if we look at their potential opportunities around circular economy creation, waste management, waste recycling, be it physical, be it associated with their materials recycling as copper, for instance, aluminium and others commodities, or whether it's actually physical waste management. Then we're talking about water specifically. Water is a huge untapped opportunity sector, because we're talking there about water treatment, and water treatment and creating a water access. And this is a patient capital. Impact investors specifically like this. And I think Nicole can elaborate more on that.
Yeah. Maybe if you want to finish, but let me turn to Nicole maybe for using that as transition. That'd be great to have a views on this, and maybe also answer some of the questions. There's a great question from Stacy about the ISO norms. I mean the TC 322. I know actually people in Latin America and in Peru specifically that look at this ISO norms. So Stacy, just reach out to me. We'll be happy to put you in contact. But maybe from your perspective, Nicole, can you comment what the great insight from Anna, and maybe comment the use of ISO TC 322 or the inclusion of these use of resources into the 43101, which is the document where you actually have the geographies reserves and the definition and detail of the project before it actually gets listed on the TSX or other indices. What's your take on this? Maybe if you can enlighten us, Nicole.
Okay, so yeah, I mean, I'd have to pass on certainly the ISO inclusion. That's certainly not something I'm that familiar with, so apologies for that. But I do think, what is very clear is there are these transitional industries that represent so much, are so vastly important, right, in the world that we have been, successful in, from a financial services community, from an investment community, to our future state. And the price on raw materials, irrespective, right, is right at the top of the pile. I think what we are seeing is we're seeing a rise in investor appreciation, preservation, and protection of our natural environment, including raw materials. And so the custodianship of those that, are close to that from an industrial perspective, I think there is a real opportunity. There is a real opportunity of adaptation, change, and transformation. And I think this is, I think Anna said it so beautifully. It's a huge opportunity. I mean, it is something that will if adopted, if taken on board, could represent clusters of new business models for the mining industry. If you look at the growth just in emission marketplaces, right? I mean, it's fascinating to see, right, how carbon offset projects are making, have and will continue to make a huge impact in trading markets. If you look again at the cost of capital in capital intensive projects such as mining, there is an opportunity to disrupt this and become an onward cycle for cheaper capital, and especially in the world of debt and green bonds, where there is downward pressure globally for investors who are fixed income biased, looking for ways in which that those structures can pay back over time. They'll be turning their attention to industries that are on the process of reinvention. I'm definitely seeing, a lot of creativity coming through in the project financing space, not just in terms of structures, but actually liquidity and syndication. So, issuance of bonds and syndication is a huge opportunity. How can the mining community play a role in that? And how can those that are, whether they be private market players or public market players, aid that and actually gain an advantage on that? And then let's not forget the geographic bias, right? I've always been a believer that emerging markets have an opportunity, certainly to leapfrog, right? Infrastructurally, that has always been, an opportunity for emerging markets. And I think if you overlay that, certainly, a lot of our participants today are from South America. If you overlay the ability to lay down greener infrastructure, relook at partnerships and your onward supply chain in with the infusion of the right technical resource, come in line with the partnerships of the finance community, whether it be a development bank or a private market investor, to aid you in the design of that, look at your underwriting, the underwriting implications of your onward infrastructure, you could really look at a very aggressive discounting mechanism for future capital. So I think there's a huge opportunity, right, in actually not the operational efficiency, but also the onward cost of capital for mining.
Yeah, I'll turn to Anna, and I'm conscious on time. We just have 5 minutes left, but that'd be very interesting maybe just to have a concrete explanation of those opportunities. I know we mentioned water already. Water is a key issue in mining in Sahel, in Western Africa, in Ecuador, in Peru, in Chile. We see this all over. You actually tend to see water as a potential development of a new class assets where actually mining companies could benefit from a better management of water. I'm sorry to just give you 3 minutes, but maybe can you actually give us some more perspective on this? That'd be wonderful.
Yeah, I think it's a lot of the conversation, and it should be the dialogue with mining communities themselves, because they're the water keepers and water safeguards of locally, and they at the front of the managing risks and local situations. So I think we underestimate what kind of toll they take on themselves, because everyone then blames them on the huge negative impact. But I would say the positive side is under-communicated as well. Talking about their positive impacts on new asset class around the water. So I'd like to connect it to their specific project level, and I'd like to reinforce the quote that the real economic value of a corporation increasingly comes not from the assets anymore that it owns, but or the employees that it supervises, but from the domain of trust it has established with local communities. How the trust is established? 2 ways. It's a sustainable water management, that's one, and it includes both operational sides and installing new types of innovative technologies to use less water, basically it's desalination, for instance, plants in the water scarce areas. That's already what mining companies extensively doing in high water stress areas like Chile, for instance. That's creating a better water efficiency, so it's dewatering systems. Then we're talking about discharge and tailing dams, which is a very separate and very complicated discussion as well. And also we're talking then, and this is all can go under their green or blue infrastructure development. Green is around this water efficiency, creating water access, and then there is a blue water infrastructure. It comes under their water stewardship more. I know that I received comment earlier that water has inherent value, and I totally agree it does, but it depends from which perspective we look, socioeconomic or financial or non-financial, and that's very important. By investing in their blue infrastructure, companies secure better relationships. Company secures it can be then quantified probably via socioeconomic development and the positive impact that companies do have. But also, if we structure it correctly, for instance, through the social bonds or blue bonds or other type of the fixed income instruments, that actually creates not just an extra cost on the balance sheet, which now, by the way, mining companies have to disclose under their IFRS 19, where they need to push projected liability closure costs on the balance sheet. So basically, from costs, we can convert it into fixed income opportunity at the later stage. However, again, we need to differentiate operations or sustainable water management, greenfield or brownfield projects. So there is a classification, and then also the post-closure or during the operations of water stewardship activities, which also can be organized in accordance to SDG, be it water access, be it sanitation. There is a different kind of classification of number 6, number 17 SDGs, and so forth, because water is not just water access, it's also infrastructure that comes along with that. And it's unfortunately or fortunately it's a non-production balance sheet. And that's an issue, which now, and it creates liability costs and costs which I see as a big opportunity. However, there's a big chunk of work needs to be done around that.
Yeah, I think that might be just the first of a series of talks on those issues. I'm happy to re-invite you in the future to continue discussing this. I think maybe as a conclusion, what's really interesting to understand with ESG finance and what you mentioned, especially on natural resources management, is that one, it unlocks value and can be very a strong incentive for investors to look at your property and even more into the long run. And second, I think is essential is also the fact that key issues right now facing mining projects are lacks of transparency, lacks of trust between communities or different stakeholders and the mining company. And actually ESG factors are probably the one vector that we're allowed to be with transparency front forward about showing how a company, is integrated into the S element, the G element, the E element. There was a question of Stacey on how to quantify the S. I'll just send Stacey to our white paper of mining risk in Latin America, and happy to engage the call on how we quantify it in terms of being able to have a risk metrics for different mining companies. Obviously, for the issues of water, I will really refer you to Anna, for example, and to the overall idea of how to reach to investors, potentially to Nicole and Anna and myself also. But again, just wanted to close this. It's 12 right on time. 12:01 just right now as I said it, but it was a pleasure to invite you into these mining coffee chats. We're going to have a follow-up conversation in the coming months, so do reach out to us if there's a topic of interest. And thank you for joining me in my living room for this 1 hour of conversation. Thank you, Anna. Thank you, Nicole, and I wish you a wonderful evening and
Thank you, Remi.
in the Americas. Cheers.
Thank you. Bye-bye. Thank you.